Happy new month. Welcome to the month of September. This again is another insightful session with Oladejo Adeyemi. And today we're going to be continuing from where we stopped at the last episode, when we were discussing the capital allowance as a concept. Remember, we've established what capital allowance, what it is, how it works, and we also try to provide how it works vis-a-vis depreciation. And there was something we indeed mentioned, that it is not claimed in lieu of depreciation. That's very important. So today we're going to be taking a deeper dive. What has changed? In terms of the rates have changed. But before we go to the rates, a very significant thing to note is the concept used to break the claim down into an initial allowance and an annual allowance. Now, initial allowance has been abolished completely. So you no longer have that style of claim where you have a particular rate set for initial allowance and then you have another rate set for annual allowance, the combination of which will then form the total capital allowance that a business or an entity is going to be claiming for a particular year. Another thing that changed again, like I mentioned, is the rate. You now also have recognition of some items, software and all of that, taxpayers or businesses used to struggle to recognize, in the past. So overall, there's a lot of incentive for companies and businesses to invest in qualifying capital expenditure. Now, qualifying capital expenditure appears like big grammar, but to break it down, it just means qualifying assets. When companies or businesses procure assets, those assets must fit into specific categories or specific classes based on what the tax laws, have provided clarification on. Remember when we introduced this concept in the last episode, we did mention that different depreciation policies of different companies we give opportunity for companies to have varying results in terms of profitability or in terms of net profitability after tax, because they have adopted different types of depreciation policy. Now, the capital allowance concept attempts to bring that equalization into the mix, and to achieve that, it therefore means every qualifying asset, every asset that any company has bought must first fit in to a particular asset category, such that it is from that asset category that you then look at the rates and the mannerism that are applicable to that particular asset. This is going to be impacting manufacturers, those that are in manufacturing line of business, and we're going to be focusing on that a lot for this month of September. The only way you can know, like I always tell people, when new videos like this are released, is by subscribing, by following on all of my social media platforms, and I encourage you to continue to do that and share freely, so that we have a population of educated people with respect to what impacts on their businesses. Until I see you next time, bye for now.